Great to have you. I really wanted to talk about this call. Why do you think the Treasury Secretary is going to matter that much?
Well, actually, I'm not convinced that Janet Yellen is going to be good or bad for gold on herself. I think that what we're talking about here is the alliance that Treasury is going to have with the Fed. And so I think that when I brought up, to buy gold is because I was going back to the last time we had a Treasury Secretary that also served previously as the head of the Fed, and it was William Miller back in the late 1970s when we had the massive reflation, and gold acted as a great hedge against that. So it's really less about Janet Yellen. It might even be more, frankly, Kelly, about Jay Powell and the Fed. And at some point, I've been in the deflation camp. I've been in the big secular bond bull camp. But, at some point, we are going to reflate so much that we're going to get the inflation. And that's really why you want to have gold in the portfolio.
And Dave, that's why I wanted to talk to you in particular about this, because it's kind of a break from what we've heard from you in the past. So, and this is really important. And Ed Yardeni was on the Halftime Report a couple weeks ago talking about the same phenomenon. He called it T-Fed, but this combination of Treasury and the Fed. And let's put aside all the independence questions and kind of focus on the real politic of it. That combination, you think? I mean, are they going to overdo it? Are they going to overstimulate?
Well, I think that there's a risk that they already have. And I'm not even talking about the Treasury. I'm talking about the Fed. We have M1 growth, Kelly, of 56% year over year. M2 is running at 25% year over year. And I think that we're now getting such dramatic, rampant monetary creation that it's going to overtake the contraction in money velocity. I'm starting to, for the first time in decades, starting to second guess my longstanding disinflation deflation view. And I'm starting to think more about the future that we are going to overstimulate and we're going to get more inflation than it's bargained for. It's actually, tell you the truth, look, it's more about the Fed. And it was when Jay Powell said that we are going to leave rates at zero. Forget about all the balance sheet expansion. We're going to leave rates at zero even after inflation gets above our magical target, elusive target of 2%. Long after we get to full employment or beyond, we're keeping rates at zero. So the Feds, they're telling you on their own, we're going to be keeping real rates negative for at least the next 3 or 4 years.
Let me just ask you, Dave, because I just want to sneak this in before we have to go. Why hasn't the bond market reacted yet? Is it never going to react? Is it just going to wait until it sees the actual inflation?
So you're talking about why hasn't the 10-year broken above 1% finally? That's what you're asking me. Well, look, we've already seen in the markets inflation expectations pick up from their lows. Real rates are less negative than they were before. But you see, it's going to be very difficult, Kelly, to get a real bear market in bonds when the cost to carry is going to be close to zero. It's like everything else in the markets. There is no Fed risk. And there's no Fed risk in the long end of the curve. So that's why, how steep is it really going to go? So you don't get bear markets in bonds unless the Fed is raising the cost to carry and tightening policy. So at worst, we're just going to stay in a range for the foreseeable future.
Shepard Smith here. Thanks for watching CNBC on YouTube.